Hello guys and welcome. My name is Bilone and today is going to be a video totally based on top-down analysis. I'm going to help you to get your top-down analysis correctly and most of the time be on the correct side of the market. And I'm also going to teach you something that a lot of people don't talk about. I've never seen anybody actually talk about this before, but I believe it is very, very important so far as technical analysis, market structure, or top-down analysis is concerned, because it is going to most of the time help to align yourself on the right direction of the market almost always. Okay, so this video is just going to be on top-down analysis. You are not going to do anything crazy. Without much ado, let's just get into it. Now, if you want to do top-down analysis, the first thing that you have to do is to be on the highest time frame. If I say highest, let me say higher time frame, okay? So we have the 4-hour time frame, the 1 hour time frame, the daily time frame being the higher time frame that we all what know. But you can also have the 30 minutes, 15 minutes being a higher time frame for somebody who is what with a scalper. But I am a day trader, so I'm going to focus on the 4 hour, the daily, and the weekly time frame. Okay. So you go to a time frame where you can see clear swing highs and swing lows, clear swing highs and swing lows. That is very important. Do not say that for me, I trade a 4 hour time frame, so I'm going to stay on a 4 hour time frame. Why you are what you are not seeing any clear structure over here. Let me start from the weekly time frame, then you know what to do. Okay. Now on the weekly time frame, it is very, very clear that the price made a higher high. It doesn't look like a higher high, it looks like a sweep of liquidity because of the wick and there was nobody close. Okay. So let's just assume it is a higher high because that is not our focus right now. Now the market came down and made a lower low, right? After a higher high and a lower low, what do you expect? What is the expectational order flow? We expect the market to continue to move up and make what a lower high. Then after the lower high has been formed, we can move what lower to form the lower low. Okay, so this market can do something like this and drop. We don't know what the market wants to do. We just have to position ourselves so that anything that happens, we know what to do. So the first thing that you have to notice is that after this lower low has formed, the market is now in a push phase. And the push phase is trading right now inside an area where the market can reverse. This is an area of supply. I hope you can see that, right? It's an area of supply, simply an area where the market consolidated a bit and what dropped. So when the market comes back to that area, we expect at least some kind of what reaction to drop the market, or maybe a little move down before the market what continues moves up if you really want to do that. Okay. So now that we are in the area of supply that is sitting right here, what you need to do is to move down to the lower time frame, like the next higher time frame, that is the daily, because you want to see what the market is actually what doing whilst it is moving to that what supply zone. Okay, so you can see the market is now building highs and lows, right? You made a higher high over here, a lower high, a low, then another what higher high, right? So understand that from here we had a break of structure. Can you see that? We had a break of structure that is sitting right here. So after this break of structure has been formed, what is the next thing, right? After a low has been formed and a higher high has been formed, what is the expectational order flow? We are expected to make what a higher low. Then after a higher low, you can make what a higher high. Can you see that? Right. So where is the market likely to what retrace to when it makes this higher low? It is likely to retrace to this other block that is sitting right here. Can you see that? Likely to retrace to this other block that is sitting right here. Now this other block is very, very important. The market can just come here and tap this area of what this area of support that is sitting right here without reaching the other block, but just mark the other block and know that the market can retrace from here to here. And when it gets here, the other confirmation that you have to look for before taking a trade, because obviously the market cannot just get here and you cannot what take a trade. Okay, you just have to wait for more confirmation. If you take a trade from here, let's say a long position, the stop loss is gonna be shady because it's gonna look something like this, right? Something like this, which unless you're a position trader, I don't advise you do this. Okay, so you just have to move down to the lower time frame to look for more precision. So now you're in the daily time frame, move on to the 4 hour time frame. Okay, now on the 4 hour time frame, and before I move on, let me show you something, right? So that everything becomes clear when you move on to the lower time frame. The market structure most of the time is formed by two major profile of the market. Just two major profile. Very important. It is this one. In the bullish scenario, we have this one. From here, we can drop or we can what? We can rise. Okay. So this is one scenario that can happen. Now, the next scenario that can also happen is that the market can also do something like this. Okay. So high, then it trace below this one, like you saw on the weekly time frame. So a higher high and what, a lower low, then a lower high, and a continue to move down, right? These things are very, very important. This one and this one, very, very important. They are almost always formed on the market when the market wants to reverse or wants to do some kind of what continuation. Okay. Now this is most of the time formed by a bearish or bullish engulfing pattern. Since you are looking at the bearish scenario this time, this is most of the time formed by a bearish engulfing pattern. And this pattern that you see here is also most of the time formed by a harami, an inside what, bar, an inside bar. So when you see the candles coming down like this, but it is still staying within a huge bullish candle or a single bullish candle, there's a chance that a candle, the market can just get to the tip or the bottom of the bullish candle and rise. If you really want to trade this one, you should wait for the market to what, to break structure like this, retrace, so that you can take the trade down to this area. So by the time that the market reaches here, if it wants to move up, your stop loss would have already been at what, break even. You wouldn't take a stop loss. If you don't want to do it like that, you have to wait for the low of this bullish candle to get broken like this, so that you wait for a retracement, a retest of the what, of the low right here, so that you trade a continuation from here. Now, very, very important. Now that you understand this, let's move on to what you're supposed to do. Let's remove this. Now, let's apply the concept that you just thought about over here. Now, on the daily time frame, we see that the market is what? The market is very bullish. Now, look at this single candle over here, the last daily candle, right? What do you see? I'm not talking about the bearish one, I'm talking about the bullish one before the bearish one. You see that this candle is bullish, and the candle that is being bearish is trading within the range of the what, of the bullish candle. And this is extremely important because it tells you that the market has not yet shifted bearish. Because like I said, you can have something like this. You can have something like this. This is the bullish candle, and this is the bearish candle that is what, that is coming. You can get to the low over here of the bullish candle, then you can what? You can move down, you can move up like this. And if you think that the market is going to sell, you are going to be on a wrong side of what, of the market, right? So let's move on. So now what you are likely, or what you are supposed to do, is to know that okay, we are trading within the range of what, this candle. You don't have to mark it, but I'm marking it for visual purpose. All right. If you keep on marking everything, your chart will be very cluttery and unclear. You don't want to see that, so just observe. Okay. So for this one, I'm marking it for clarity's sake. Now the next thing that you have to do is you have to move down time frames. 4 hour time frame. Now on the 4 hour time frame, we know where we are. We know that we can make a retracement from this area to this zone that is sitting right here. Okay. From this area to this zone that is sitting right here. But we are still trading within this daily range, and we can move up from here. Okay. Now pay attention to the 4 hour time frame, because when you look at the 4 hour time frame too, there's an area sitting right here where the market can reverse to before it also comes. Right. So we have this daily demand, we have this 4 hour what, demand. Most of the time, what is going to happen is that the market is just going to trade to the 4 hour demand like this, retrace a little bit and what, and dump to the daily what, demand. The 4 hour demand is always, let me not say always, most of the time going to get a reaction before the higher time frame what, demand, or the time frame above that one is going to what, is going to be traded towards, right? But the market can do whatever that it likes. It can just retrace to this area and still pump up, right, without touching the daily what, demand. So you just have to adjust yourself to what the market or the market structure, the price action or whatever is telling you. Okay. So now that we know where we are on the 4 hour time frame, and also on the what, on the daily time frame, you can now move on to the 30 minutes time frame, the 1 hour time frame, 15-minute time frame, for what? For more precision. Okay. Remember what I told you. I said we can trade like this, get to the tip of the what, of the daily range that we have marked, then we can what, move away from there. Right? We can move away from there. So if you go to the lower time frame, like the 15-minute time frame, the 30-minute time frame, or the 1 hour time frame, and the price is already at the bottom of this area, don't take a trade. Instead, you wait for the market to break it, retest it, so that you can take a trade to this demand zone that is sitting right here, and possibly this area that is sitting right here. Do not take the trade. Instead, you wait for that one, or you wait for a trade like this, market structure shift, then a retracement, then you move up. Right? That is going to be a bullish engulfing pattern, of course, right? Like I said, the market strategy shift is a bullish engulfing pattern. You want to just focus on that. All right. So now we know, move on to the what? Move on to the 30 minutes time frame. Now, what you want to see is within this range, what is what's happening. You want to see higher highs and higher lows, so that you can position yourself for a buy or a sell. Okay. Now let's move on to the 30 minutes time frame. 30 minutes, 30 minutes. Have you seen how beautiful this is? Now I know where I am on the higher time frame. I know that the market can retrace here and the market can also what retrace here. So I'm just what looking for entry signals. Okay, entry signals. Right. Have you seen what I thought about on a higher time frame? A very bullish momentum up here, and now look at what you are getting. High, low, high, low, high, low. You can move here and trade up like this, or you can move here, trade below, retest, and go to the what? Go to the 4-hour demand. So it happens all the time. It happens all the time. And I saw that on a higher time frame because I just knew that this is what an inside bar or trading. So this is likely what can happen. It repeats almost all the time. It repeats almost all the time. And this is very important. I don't know how much I should stress this for you to understand the gravity of this information that I'm trying to give you for free. No good, no gatekeeping. I'm giving it to you for free because I learned from a lot of people for free on YouTube too. People like GFS, people like ICT, people like Trace by Side, people like FSLSG, most of the gurus I learned from them, and I combined everything to build my own what system. Okay, so that's why I'm giving everything that I've learned on market strategy and everything. Okay, no gatekeeping. I never do gatekeeping. I'm like trade by side, no gatekeeping. Okay, so now that we know that we are here, what we can do basically is we can see that the market has done a break of structure over here. If we want to take a counter trade, the market has done a break of structure over here from here. So what you can do, I didn't show. Let me use a line. I don't want this video to be long, right? What you can do is after this break of structure, you wait for a retracement into another block, right? This area is the other block. You can see this clear. It's not something that I have to show you. Then you can take a trade, a short position from here. Your stop loss above this area that is sitting right here, the other block, and you target the 4-hour demand that is sitting right here, right? But make sure that you target this area first because, like I said, the market can just come to this area and what retrace up because this is the overall what daily range that you are trading within. If we had broken below the daily range like this with an engulfing pattern, it should have been the case that we are just looking for a retracement for the market to what down to the what 4-hour demand that is sitting right here. But because we didn't create an engulfing pattern and we are trading inside the daily bullish candle, we can get something like this in a push up because you can see this demand that is sitting right here. This is no joke, right? This is no joke. So you should take notice of it and be very, very what wary of it when you're taking a trade. So by the time that the market moves in your direction, if it taps here and moves in a direction, make sure you put your stop loss to what break even before the market even gets here because it can skyrocket, move up and take your stop loss out, right? So as you can see, this is extremely easy, very, very easy, nothing too complicated. That's just basic top-down analysis. I didn't do anything. All that I did was go to the higher time frame, look at where the market wants to go and how the market is behaving, come to the lower time frame with a little bit of what experience. I just what pick the bias, trying to place a trade over here to target the areas that I believe the market is going to what move towards. All right, so that is going to bring us to the end of this video. I think I will do another video, but that is going to be based on what the daily bias, which is a concept that a lot of people would complicate, but it's actually what very easy. All right, that is going to be all for this video. See you next time. And don't forget to like and subscribe to help us grow the channel. And we are going to keep on providing value for you. Bye.